Welcome to The Explainer. This month, we're unpacking December 2025. It was a month of really sharp reversals and a ton of noise. So we're going to cut right through it, synthesize what really mattered, and set you up with a strategic look ahead.
So when you look back at the month, the whole thing was really a battle between three huge narratives. First, you had the big question: is this AI boom just a massive bubble waiting to pop? Then you had the Fed pivot. Were central banks finally giving us the all clear? And, of course, China. Could their stimulus actually get global growth fired up again? By the end of December, the market, well, it had made its decision pretty clear.
You can really trace the entire story of the month through just 4 specific days. These were the critical turning points. We started with a big AI reality check, then we saw this major divergence right in the middle of the month, and it all came together in this powerful rally at the very end. So let's break down each of these narratives one by one.
So first up, we've got to talk about the biggest story of the entire year: artificial intelligence. After a full year of absolute euphoria, December was the month when the market finally slammed on the brakes and said, okay, show me the money. The demand for actual, tangible profitability was suddenly front and center.
Yeah, this sentiment right here pretty much captures the new mood perfectly. The first real crack in that happy AI story showed up on December 4th. That's when Microsoft, and this is rare for them, announced they were cutting sales quotas for their AI software. And that was a huge signal, right? It basically told everyone that selling this stuff to big companies wasn't the easy slam dunk the hype made it out to be. And then things took an even sharper turn. Over just 2 days, on December 10th and 11th, we got this brutal 1-2 punch from a couple of tech heavyweights that literally sent shockwaves through the whole sector. First up was Oracle. And look, their cloud revenue was actually strong, but the market just blew right past that. What everyone fixated on was this plan for a massive $50 billion spending spree on AI infrastructure. And how are they going to pay for it? By taking on a mountain of new debt. Investors they completely balked at the price tag for this AI arms race. And bam, the stock got hammered, down almost 11%. And then, the very next day, Broadcom just poured gasoline on the fire. Get this. They reported an incredible 74% growth in AI chip revenue. Just staggering numbers. But, and this is the crucial part, they warned that the profits on those chips were getting squeezed. In other words, capturing all that crazy growth was getting more and more expensive, and it was eating into their margins. The stock plunged more than 11%. So by mid-December, the fear was real. The dominant narrative was, this is a debt-fueled AI spending bubble, and there's no clear path to making any money off it. But by the time we got to Christmas Eve, the story had completely changed. News broke that NVIDIA was getting ready to ship its new H200 chips to China. And that was the key. It confirmed this whole spending cycle wasn't just some US-centric bubble. No, this was global, it was structural, and it had a much longer runway than the bears were giving it credit for. Okay, so while the market was trying to figure out the future of AI, this whole other major theme was bubbling up. This great divergence in what central banks were doing. All of a sudden, the world's big monetary policymakers were not on the same page. At all. And you can see just how much they were splintering right here. In the US, you had the Fed delivering that expected quarter-point cut, but basically telling everyone, don't expect another one for a while. Then over in the UK, the Bank of England also cut, but they sounded way more eager to keep cutting. And then you've got the European Central Bank just holding firm, with markets actually starting to price in a potential rate hike next year. When you have this kind of divergence, it's just a recipe for some serious volatility across all kinds of assets. And what's really fascinating here is the division inside the U.S. Federal Reserve itself. That December decision had 3 members voting against it, 3 dissenters. That's the most we've seen in over 6 years. So this wasn't some unified committee marching in lockstep. Nope. This was a fractured group, which is a massive signal of just how uncertain even they are about what to do next. All right, on to our third major theme, which takes us over to China. And that is Beijing's really ambitious plan to try and rebalance its gigantic economy, to pivot away from relying on exports and instead get its own people to start spending. The single most important takeaway from their big Central Economic Work Conference was one massive number: $22 trillion. That's how much money is sitting in household savings accounts, and that's the pool of cash Beijing is desperate to unlock to fuel a whole new engine of domestic growth. But this is where you see the core tension in their whole strategy. Because while Beijing is talking a big game about a domestic pivot, their export machine is just firing on all cylinders. I mean, it hit a record $1 trillion trade surplus. That creates a ton of friction globally and makes this whole rebalancing act incredibly complicated.
So the big takeaway on China is this. Don't think of this as some huge Western-style stimulus where they're just handing out checks. It's not that at all. The plan is all about fostering what they call new productive forces. This is a very targeted, very strategic industrial plan aimed squarely at the key sectors of the future. We're talking AI, biotech, EVs, and of course, semiconductors.
Okay, so you've got this AI reckoning, you've got central banks going in totally different directions, and you have China's really complex pivot. How on earth did the market digest all of that? Well, somehow it all came together and fueled a really powerful year-end rally.
And by Christmas Eve, the market's verdict was in, and it was loud and clear. Things were just firing on all cylinders. The strength in the US was undeniable. The S&P 500 hit a new record close. And it wasn't just the US. We saw solid gains across Asia too, which showed there was real optimism about that global AI spending cycle and what was happening with China's new policies.
So what was the fuel for this Santa Claus rally? It really came down to a huge flip in market psychology. For months, good news was bad news, right? A strong GDP number would have sent markets tumbling because it meant a more aggressive Fed. But then we got this surprisingly strong 4.3% GDP print, and suddenly, good news was good news again. The market didn't see it as a threat anymore. It saw it as proof that the economy was strong enough to pull off that elusive soft landing.
And so that brings us to the big question heading into the new year. The market has settled the debate for 2025. The verdict is soft landing. But here's the thing. Whenever a narrative gets this popular, when everyone agrees on it, that's usually when the biggest risks are lurking in the places nobody is looking. Which leaves us with the critical question. What is the market completely ignoring as we head into Q1?